For the last 3 years, rent across America did the unthinkable. It climbed higher and faster than any time in modern history. From Miami to Seattle, landlords were the new kings of the economy. They raised rents by hundreds overnight, confident that tenants would pay anything just to stay housed. But in 2025, that power is collapsing. Across the country, cities that were once booming with bidding wars are now drowning in empty apartments. For the first time in a decade, rents are falling, and fast. Developers built too much. Investors borrowed too aggressively. And the people they counted on, the renters, have hit their limit. In some metros, prices are plunging double digits. Incentives, discounts, and free months are back. Landlords are panicking, tenants are walking away, and the balance of power in America's housing market is shifting once again. This is Discover the Nation, and today we're counting down the top 10 US cities where rent is collapsing and landlords are panicking in 2025. Stay with us until number 1, because what's happening right now could change the rental market for years to come. And if you want more in-depth cinematic breakdowns of America's housing trends, hit subscribe right now and let's dive in. Number 10, Austin, Texas. Austin's rise was legendary, and so is its fall. Between 2020 and 2023, the Texas capital became the crown jewel of America's tech migration, a magnet for remote workers, venture capital, and billion-dollar startups fleeing the coasts. The city branded itself the new Silicon Valley, and for a while it lived up to the name. Downtown cranes filled the skyline, luxury towers sprouted overnight, and landlords couldn't raise rents fast enough. But in 2025, that fever has broken hard. Average rent is down 14% year over year, the steepest decline in the entire Sunbelt. Thousands of glossy new apartments built during the boom now sit half-empty, their rooftop pools echoing with silence. Developers who once bragged about 12-month waitlists are offering desperate deals: free rent for 3 months, waived deposits, even concert tickets to sweeten the lease. The reason? The tech bubble burst. Layoffs from giants like Meta, Oracle, and Tesla have gutted Austin's high-income renter base. Once called Silicon Hills, the nickname now feels like a cruel joke. In downtown towers like the Independent and 70 Rainey, vacancy rates have hit 10-year highs. In East Austin, once the heart of the city's creative rebirth, landlords are slashing rents just to compete. Those who over-leveraged buyers of luxury condos at record prices are watching profits evaporate under the weight of high-interest loans and vanishing tenants. For renters, though, it's a long-awaited reversal. The city that became unaffordable overnight is finally cracking, giving power back to the people who keep it alive. In 2025, Austin's story is clear: the city that rose fastest is falling just as hard, and the echo of that fall is shaking the entire Sunbelt. Number 9. Miami, Florida. Miami's rental boom wasn't just big, it was blinding. Fueled by the pandemic exodus, crypto wealth, and global investors chasing sunshine and status, the city became a playground for billionaires and remote workers. Between 2020 and 2022, rents exploded by over 60%, pushing locals out and turning every downtown high-rise into a symbol of excess. But in 2025, the glitter has faded and a crash is unmistakable. Average rents have fallen 11% since last year, with vacancies surging across Brickell downtown and Miami Beach. The once hyped luxury towers that boasted ocean views and infinity pools are now advertising free parking, zero deposits, and even $2,000 gift cards just to fill units. And it's not just lower demand, it's rising costs. Insurance premiums have tripled, leaving many landlords underwater. HOA fees have skyrocketed as buildings scramble to meet Florida's new post-collapse safety laws. The result? Thousands of investors are hemorrhaging cash every month. Condos once worth $900,000 are selling for $700,000 or sitting unsold. Airbnb owners who thrived on vacation demand are abandoning the market as tourism softens and maintenance costs crush profits. Even foreign investors, long Miami's financial lifeline, are backing out, spooked by escalating storm risks and endless special assessments. The view from above still dazzles: turquoise water, skyline glittering in the sun, but behind the glamour, the financial math is breaking. In 2025, Miami is the cautionary tale of overconfidence. When luxury outgrows logic, even paradise can collapse. Number 8, Atlanta, Georgia. Atlanta was supposed to be different, the city that had it all. A booming job market, affordable housing, and a wave of migration from both coasts made it the safe bet of the South. Developers rushed in, pouring billions into new apartment complexes from Midtown to Sandy Springs. Between 2021 and 2024, more than 50,000 new units hit the market, a number the city simply couldn't absorb. And now in 2025, the boom has turned to a bust. Rents are down 9% year over year. Vacancies are climbing. High-rises that once filled overnight now sit half-empty. Landlords are offering 3 months free, complimentary parking, and zero security deposits, anything to lure tenants back. But the problem goes deeper than oversupply. Wage growth has flatlined. Inflation has eaten into household budgets. Student loan payments are draining younger renters. Millennials and Gen Z are doubling up, moving home or leaving the metro altogether. Even the once bulletproof suburbs, Cobb, Gwinnett, and Henry County, are softening. Single-family rentals sit vacant and short-term investors are slashing rents just to stop the bleeding. For years, Atlanta was the future of affordable growth. Now it's a symbol of imbalance, a city where the cranes never stopped even after the demand did. This didn't crash overnight, it suffocated slowly. Number 7. Las Vegas, Nevada. Vegas has always been a city of winners and losers, and right now landlords are on the losing side of the bet. For years it looked unstoppable. New residents poured in from California, chasing lower costs and brighter horizons. Investors snatched up homes. Short-term rentals exploded. Everyone assumed the good times would roll forever. But by 2025, the dice have gone cold. Rents are down nearly 10% since 2023 and vacancies have doubled. Entire apartment complexes in Henderson and Summerlin stand half empty. The glitzy skyline still sparkles, but beneath it, supply has far outpaced demand. Tourism, the city's economic heartbeat, still hasn't fully recovered. Casino hiring is down. Conventions are smaller. Tips aren't what they used to be. Meanwhile, thousands of Airbnbs are flooding the long-term market as owners scramble to recover profits. Homes that rented for $2,400 now languish at $1,900 with no takers. Investors who banked on quick returns are quietly exiting, selling below purchase price to avoid deeper losses. And yet, the overbuilding continues. Projects launched at peak optimism are now adding more luxury units no one's asking for. In 2025, Vegas feels eerily familiar. 2008 revisited. Different decade, same gamble, too much speculation, too little sustainability. Number 6. Phoenix, Arizona. The blazing heart of the Sun Belt boom is cooling faster than anyone expected. Just 2 years ago, Phoenix was the poster child for migration and growth. Families from California and the Midwest poured in, fueling record construction and rent hikes. Developers couldn't build fast enough. Entire suburbs in Chandler, Glendale, and Mesa sprang up overnight, but in 2025, that optimism has melted into oversupply. More than 30,000 new units hit the market in 12 months, and demand simply isn't there. Average rent has plunged 12%. Landlords are throwing every trick at tenants: free months, furnished move-ins, prepaid utilities. Complexes that once had waitlists now beg for occupants. Insurance and maintenance costs have skyrocketed. Investors who bought luxury new builds at pandemic peaks are underwater, owing more than their properties are worth. The job market is tightening. High interest rates and slowing migration have frozen corporate expansions. From downtown to the East Valley, Phoenix is learning that growth without balance always ends the same way. By 2025, it isn't just cooling, it's correcting. Number 5. Dallas, Texas. For years, Dallas looked invincible. Corporate relocations poured in, young professionals flooded uptown. Suburban sprawl seemed limitless. Developers and investors called it the economic capital of Texas, confident it could never slow down. But in 2025, that confidence has cracked. Rents in Uptown, Plano, and Frisco are down around 10%, and Class A vacancies are the highest in a decade. The skyline still shines, but landlords behind those glass towers are panicking. Why? Overshoot. Between 2021 and 2024, Dallas added tens of thousands of new units just as renters tightened their wallets. Inflation crushed disposable income. Interest rates stayed high. Potential renters moved home or shared space. Landlords are scrambling with free utilities, covered parking, and rent credits. Investors relying on cash flow are now in the red, with rising insurance premiums and property taxes swallowing profits. The city that symbolized endless prosperity is now caught in a loop: too much luxury, not enough affordability. Even corporate strength can't save the market this time. Number 4. Boise, Idaho. The pandemic's golden child has lost its shine. A small mountain city that became America's housing miracle. Cash offers, bidding wars, and dreams of a simpler life. Prices doubled. Rents surged. Developers raced to meet what seemed like infinite demand. But by 2025, the magic is gone. Rents are down 13% year over year, and vacancy rates are climbing faster than anywhere in the Mountain West. Downtown apartments that once leased in days now sit for months. Hundreds of sleek high-end units built during the boom are drowning in inventory. Boise's renter base, teachers, nurses, and service workers, never had Silicon Valley salaries. They watched rents surpass $2,000, then watched the Californians leave. With the remote work wave receding, Boise's inflated market is stranded. In the suburbs, Meridian, Nampa, Eagle, projects pause mid-construction. Materials sit idle, investors liquidate at losses. Local shops that thrived on out-of-town traffic are cutting hours or closing. Landlords slash $300, $400, even $500 off monthly rents with free months and upgrades, and units still linger. The once booming skyline feels frozen in time. The escape ended. Reality returned. Number 3. Seattle, Washington. For the first time in over a decade, Seattle's skyline tells a story of uncertainty. After years of unstoppable growth, rents soaring, cranes everywhere, tech money fueling the climb, 2025 has brought the reckoning. Rents are down 10%, and the towers that symbolize prosperity now symbolize vacancy. Layoffs from Amazon, Microsoft, and a wave of startup collapses have gutted the high-income renter base. Downtown buildings with waiting lists are offering cash bonuses and free rent to attract tenants. In Capitol Hill, South Lake Union, and Belltown, luxury apartments advertise discounts once unthinkable. Even in the suburbs, Bellevue, Redmond, Kirkland, the story is the same. Renewals are plummeting, tenants are leaving. Projects are delayed or abandoned, leaving half-finished structures scattered across the skyline like reminders of overconfidence. But the shift isn't just economic, it's psychological. People are choosing smaller, more balanced lives in cheaper states. The migration out isn't massive, but it's relentless. With each family that leaves, stability goes too. Tenants are negotiating again, demanding flexible leases and lower prices. The glass towers still gleam in the mist, but beneath that glow lies fragility. Number 2. San Francisco, California. If any city defines the word collapse, it's San Francisco. Once the crown jewel of American innovation, this city's rental market has unraveled into something unrecognizable. Rents are down 15% year over year, and downtown vacancy rates have shattered records. Luxury towers that demanded $4,000 a month now sit empty at $3,000, with incentives. The exodus of tech workers never reversed. Remote work hardened into permanence. Downtown, once pulsing with startups and dreamers, has become a canyon of quiet glass. Entire blocks are ghost corridors, dotted with for lease signs that have become part of the scenery. Landlords who once flaunted passive income are begging for tenants. Property taxes, maintenance, and insurance have doubled, wiping out profits. Investors who bought at the top are trapped, unable to refinance without losing millions. And beyond economics lies perception. Concerns over crime, homelessness, and quality of life have turned renters away in droves. Many choose Sacramento or Austin instead, places offering space, safety, and sanity. Restaurants, boutiques, and galleries that define the city's charm are closing, hollowing out the culture that made San Francisco irreplaceable. Even its vaunted tech identity is fading as companies abandon headquarters for cheaper hubs. The city that set the housing price floor for the nation is now showing how far the market can fall. This isn't temporary, it's transformational. Number 1. New York City. The empire is finally showing its cracks. For generations, New York's rental market was bulletproof. No matter the economy, no matter the crisis, demand always returned. But in 2025, that myth is fading. Average Manhattan rents are down 12%, while Brooklyn and Queens are off by as much as 15%. For the first time in decades, renters have the upper hand. Incentives are back, free rent, waived deposits, even luxury upgrades to lure tenants. Developers overbuilt between 2021 and 2023, betting on endless wealth to fill their towers. Instead, those glittering high rises now overlook half-empty streets. Corporate layoffs in finance, media, and tech have eroded the renter base that fueled the city's resilience. International buyers, once the secret engine of Manhattan real estate, have pulled back amid global instability and tax hikes. Even the ultra-wealthy are trimming sails. Luxury rentals on Billionaires Row are being repriced down by hundreds of thousands a year, while owners of mid-market buildings face brutal refinancing rates that destroy cash flow. For smaller landlords, foreclosure whispers have begun. Younger professionals who once paid any price for a studio are fleeing for Charlotte, Nashville, and Philadelphia. The culture, the speed, the chaos, it's all still here, but fewer can afford the cost of admission. New York's decline isn't dramatic, it's deliberate. A slow contraction of a city learning its limits. The skyline still shines, but beneath it lies a new reality, ambition finally meeting exhaustion. Across the United States, a quiet revolution is unfolding. For the first time in over a decade, tenants are back in control. The era of bidding wars, blind applications, and ruthless rent hikes is ending, replaced by empty units, falling prices, and desperate landlords. But this isn't just a price correction, it's a cultural shift. Millions of Americans are questioning whether renting, or even owning, makes sense anymore. In an economy where costs rise faster than wages, developers built luxury, renters wanted livable, investors chased returns, families needed stability. Now the reckoning has arrived. Some cities will recover, others will shrink. But everywhere, the lesson is the same. Housing markets don't defy gravity forever. And nowhere is that lesson more vivid than in Texas. The real estate giant of the South, now showing cracks in 2025. Median home prices across the state have fallen about 3.2% year over year, now averaging around $331,000, over $70,000 below the U.S. median. Austin leads the decline, at down 6.4%, followed by at negative 4.1%, San Antonio at negative 3.5%, and Houston at negative 3.5%, and Houston at negative 2.8%. Inventory has surged 30.7%, with more than 132,993 active listings. And homes take about 105 days to close, up sharply from last year. This marks a major shift from the 2020 to 2022 surge, when low taxes, cheap land, and headline relocations by Tesla and Oracle drew hundreds of thousands of new residents. Listings vanished overnight, prices skyrocketed, but by 2024 supply doubled, erasing seller dominance. With mortgage rates hovering between 6.8 and 7.2%, affordability became the new ceiling, and demand slowed hard. The psychology flipped. In 2021, buyers feared missing out. In 2025, they feared overpaying. Bidding wars disappeared, replaced by seller concessions, covering closing costs, buying down interest rates, and dangling incentives. And yet, experts say this isn't a crash. Texas didn't overbuild in 2008, and population growth remains strong. What's happening is a recalibration, a repricing of risk. The affordability tells the story. A $330,000 home at 3% interest cost about $1,400 a month in 2021. In 2025, at 7%, that same home costs more than $2,600 before insurance and tax. Many middle-class buyers are priced out. Sellers cut prices or wait months for offers. Inventory may be higher, but sales are down only about 1.5% statewide. A market that slowed, not shattered. Insurance premiums add another layer of pressure. Across Texas, especially in Houston and along the Gulf, rates have jumped 20 to 40% as carriers react to billion-dollar storm losses and wildfire risks. For many buyers, insurance adds $200 to $300 to monthly payments, wiping out affordability gain. Lenders require large escrow reserves, delaying closings that already take more than 100 days. Insurers are pulling in flood-prone zones, and even minor FEMA map updates can freeze entire neighborhoods overnight. In this new climate, liquidity is drying up, fewer deals close, and those that do take longer. Realtors call it a pause market. Transactions happen, but at a crawl. Sometimes the slowdown hits instantly. A single Federal Reserve sentence hinting at delayed rate cuts can stall deals statewide within hours. Coastal insurance moratoriums after storm warnings do the same. These micro freezes stop the market for days at a time, creating uneven momentum. Buyers now watch interest rates like weather reports. One realtor summed it up: "We're not waiting for prices to drop anymore. We're waiting for rates to breathe." Meanwhile, Texas' growth model is under strain. The no-debt income tax promise attracts residents, but limits funding for infrastructure. Local governments face zoning backlogs, staffing shortages, and rising construction costs. Developers in Austin and Dallas complain of doubled permit times. Houston wrestles with flood regulations and inspection bottlenecks. The result is a tangle of delays that reinforces the market's sluggish feel. But the Texas market isn't one story, it's several. Austin, hit hardest, is down 6.4% as tech layoffs and luxury overbuilding weigh on prices. Fort Worth shows mixed results, some suburbs down 4%, others slightly, thanks to corporate relocations. San Antonio is off around 3.5% as insurance and taxes offset its affordability edge. Houston remains relatively stable, supported by oil jobs, but pressured by insurance costs. And smaller cities, Waco, Tyler, College Station are bucking the trend with modest growth, powered by remote workers and retirees chasing value. This uneven pattern defines 2025. Texas isn't collapsing, it's distributing wealth and demand shifting outward from overheated metros to balanced, mid-sized markets. The frenzy of 2021 has given way to a cautious equilibrium where patience and negotiation rule. By late 2025, analysts project prices to stay flat or dip slightly before rebounding in mid-2026. Assuming rates ease, the fundamentals, strong job creation, population growth, a pro-business climate, remain intact. The scoreboard sums it up. Median price near $331,000, inventory up 30.7%, home selling in 105 days, and sales down just 1.5%. For buyers, this is a moment to wait. Line up phone ads in pounds selectively. For investors, it's a window to buy quality at a discount. Careful with conservative underwriting. And for homeowners, it's a reminder that the market didn't crash, it normalized. The Texas housing story 2025 isn't one of destruction, but discipline. The boom has cooled. The market is breathing again. And the state's vast landscape is finding a slower, steadier rhythm built to last. You've been watching Discover the Nation, your home for cinematic deep dives into America's biggest transformations. If this breakdown was eye-opening, hit subscribe, turn on notifications, and share this video. What's happening in housing today is just the beginning. And as always, the numbers tell the story.